Now I'm going to teach you 1.2, chapter 1.2. Okay. So basically this chapter deals with accounting concepts and accounting conventions. So I'll be directly moving on to explain accounting concepts. This is something which we have already learned in our 11th and 12th grade, but it covers stream students. But there are students who come from science stream as well, and if they have gone through foundation or CAT, they might have got something from this. Like they might have got the basics, very foundation. This is an easy thing. Okay, so let's go through it. Accounting concepts. So first one is entity concept. So to explain this, imagine a business as a separate person, like a character in a play. This concept says that the business is different from the people who own or run it. Okay, so when the business spends money, like paying for personal expenses, we record it in the business's book, not the owner's. Okay, whenever the business spends for any personal expenses, we record it in the business's book and not the owner's. Let's say an example: if the owner uses business cash for personal stuff, we note it down as a business transaction. So what happens if the owner is going to take the business's cash for the owner's personal stuff? What happens? We'll record it in the business transaction. Okay, so when business spends money, we record it in the business's book and not the owner's. If the owner is going to pay for his personal expenses by taking that money from the business, that will be recorded in the business's book, because we are treating business and owner as two different entities, two different individuals. Okay, we are going to treat them as two different entities. That is the first concept, entity concept. The second concept is going concern concept. Like here, think of a business as a marathon runner. We assume it will keep running indefinitely unless there is strong evidence otherwise. Right? That is, this concept lets us carry forward values like assets and debts from one year to next year without questioning their usefulness. It's like saying the show must go on for the business, right? So going concern concept is that we are assuming, or we can say that concept, that business will be moving on forward. We don't know when it's going to end. It has a indefinite life. It is. We are assuming that the business is having indefinite life. Okay, so that is going concern concept. Now we say next concept is accounting period concept. Picture the business year as a series of episodes, like seasons in a TV show. Each episode covers a specific time, right? A quarter, maybe half year, or a year, right? Each TV shows, series or seasons will cover a specific time. So we analyze the business's performance in each episode and show its financial position like a snapshot in the balance sheet, right? So we know that we are comparing our business with a TV show, and we know each season might cover a specific time. Likewise, when we analyze a business's performance, let's say in each period we are going to analyze the business's performance. And we'll show its financial position in the balance sheet. Okay, that's it. Then it's like checking how well the character did in each episode of the business story. Okay, so this is just like I'm just comparing it with the business TV show. Okay, you shouldn't write about TV show and all when you're having this question in your exam paper. Fine. Fourth concept is money measurement concept. Imagine everything in the business world as coins or notes. If we can't express it in money terms, we don't record it, right? So even if the business owns cars, computers, or raw materials, we convert them into money values, right? But remember, this concept has limits. It doesn't consider real value changes due to inflation or exchange ranges. Okay, so this is about money measurement concept. We'll be measuring almost everything in money terms, but also we have to remember is that this concept has limits. Not everything can be valued in money. Next concept will be accrual concept. Yes, so next is accrual concept. Imagine a business as a theater play. So I'll be for each concept I'll be asking you to imagine something so that you will be able to connect it easily. Okay, so imagine a business as a theater play. In this concept, we record transactions when they happen, not when cash changes hands. Okay, we record transactions when they happen and not when cash changes hands. Like usually we used to write, we know there is cash transactions, and we used to write it down. Whenever I give money to my friend, I will record it. Likewise, here what happens is that there is no involvement of cash. Yes, cash have to be given or cash have to be paid, but not at the moment. Okay, so that's why they are saying we record transaction when they happen. Like for saying, I'm saying to my friend, let's say I have given some service to a customer, and that customer is someone which I already know. Okay, so I'm giving him I'm giving him some days to pay the amount. So I have already delivered the service, whatever it is. I have already delivered the service, and he is going to give me cash after 2 days. So I am recording this transaction at the moment, now itself, not 2 days after when he gives me the money. Okay, so that's what we call accrual concept. So even if no money is exchanged yet, like credit sales, just like the example which I told you, we still record it, right? It's like I'm not going to wait till I'm going to wait till I receive the money. I'll be recording it the moment the transaction has already been finished. Like from one part the transaction is covered, like I have given my service, I have already delivered the service, or I have already given him the product or the good. Okay, so and at that moment itself I'm going to record. That is what we call as accrual concept. Next concept is dual aspect concept. Picture every transaction as a seesaw. We know what is a seesaw is. I'll be showing you a picture. That is a seesaw. We'll find it in parks and all for kids to play. So when you buy goods with cash, one side goes down and the other side goes up. Okay, so when one side goes down means I'm referring to the amount we are going to pay in order to get that good, the cash paid. And the other side goes up, right? When we paid cash, what did we receive? We received a good. So that is the side which goes up. Okay, so that's it. So this concept ensures that every transaction affects at least 2 accounts. Okay, this thing is very, very important. You have to keep this in your mind. This concept ensures that every transaction affects at least 2 accounts. Okay, so we know assets is equal to liabilities plus capital. Likewise, okay, so this is about dual aspect concept. Next, move on to matching concept. Think of this as a dance. Okay, think of this as a dance. Revenues, or you can say money earned, and expenses, that is money spent, should be recorded in the same period. They are saying matching concept. It's like dancing and sing. When you earn, you also account for the related expenses. Okay, so whenever you are receiving the money whenever you are getting any revenue, we are also record the expenses which is related to that revenue at the same period itself. That is what we call as matching concept, nothing more. And the next concept is realization concept. Here I'm asking you to imagine you're selling concert tickets. You know concert tickets, you know BTS and all. I'm also an army, but not that much of an army, but I know them and I used to hear 1 or 2 songs of them. Okay, let's get back to our topic. So you know concert and all. So you are one that's selling a concert tickets. You only recognize revenue when the tickets are used, when the show happens, right? That tickets are used so that the people can come and see the show, right? So you only recognize revenue when the tickets are used. So an order isn't enough. Actual delivery and billing is matter. Okay, actual delivery and billing matters. I'm asking you to imagine that you are selling concert tickets, because that concert tickets, we will say, like, just say I have bought a concert ticket to watch BTS videos itself, BTS concert itself. For BTS concert, I have bought tickets. So when can I say that I received revenue? Revenue in here is I have bought the tickets, and when I am able to see, when I am allowed to see the show, that is the revenue for me at that time, right? So that is the realization concept. So you can only recognize revenue when the tickets are used, when the show happens, right? So an order isn't enough. Actual delivery and billing matters. And a final concept under accounting concepts are cost concept. What is it? Consider assets like machines as historical artifacts. We record them at the cost incurred to acquire them. Okay, we'll write the cost, like for example, let's say whatever machinery, I'm going to buy a machine, and that machine costs what? Let's say 10 lakhs. So that is the amount that is incurred to acquire that thing, right? Even if their market value changes, we stick to the original cost. Cost concept is also called as historical cost. Okay, this is also termed as historical cost. So that is an example in our study math. A packing machine was purchased by Bharat Limited for 40 lakhs. Okay, they have bought a packing machine for 40 lakhs and an amount of 30,000 was spent on transporting the machine to the factory side. That machine have to be transported from the place which it was sold to the place which we are using. Let's say the factory. Okay, and it cost rupees 30,000. And further, rupees 20,000 was additionally spent on its installation. Let's say not every machines can be bought at the moment itself. We cannot use a machine. It might have some things to fix and some things to make right. There will be users manual and all. We have to sometimes even we won't be able to install it ourselves. We have to call someone from outside, or you can say the company people itself have to come and help us in installing it, right, to make it work. So that is what we call installation price, and we will be spending like rupees 20,000 for it. Hence, the total amount at which the machine will be recorded in the books of accounts would be aggregate of all this cost. That is 40,50,000. Okay, this is what we call as historical cost. So nothing but we have to consider everything from the purchase of, from the acquisition of that asset till its installation. We have to consider everything together, and that will be considered as the cost. Okay, everything together till the installation. Okay. Till the put to use, we have to consider all the cost relating to this machinery, and that will be considered as the original cost. We can say cost. Okay, so that is what we call concept, cost concept. That's it. Now let's start with accounting conventions. What does it say? Now let's begin with accounting conventions. It is very easy. Okay, the first convention is conservatism. Here also I am asking, so I will be asking you to imagine things. Here in conservatism convention, I am asking you to imagine that you are packing for a trip. This convention says pack for the worst weather. That is, this convention is asking us to assume the future is uncertain. We are assuming that this particular asset might require repair in the future. It is not, it doesn't have any problem at the moment, but just we are assuming that this machinery can get, right? There is a possibility that this machine have to go through some repair. So I am setting apart some money for it now itself. Okay, but not potential gains. Okay, only losses, only those outflows of cash we are going to record. We are assuming that, we are presuming that something something even before that's really going to happen. Okay, but only losses and expenses are what we are going to record. We don't record that potential gains. Okay, it's like carrying an umbrella even on sunny days. Better safe than sorry. Okay, so that is conservatism concept. And the next one is consistency. Okay, that is conservatism is a convention, it's not a concept. Next one is consistency. Think of accounting rules as dance steps. We have already used dance before, I guess, right? For some concept, I think matching concept, we already used dance. Doesn't matter. Think of accounting rules as a dance steps. Consistency means doing the same dance moves throughout the show. Okay, doing the same dance moves throughout the show. We have to maintain that. Throughout the show, we have to maintain that dance move. Okay, people are going to howl on you. People are going to throw tomatoes at you if you're going to keep continuing to the same dance move. But in business, we have to do that. That is changing steps too often. That is inconsistent rules. We are not at all consistent in whatever we are doing. People, the audience, or you can say the customers doesn't like it. They are not at all consistent in whatever they're doing. That's what they will think. Okay, so changing steps too often confuses the audience. Here, our investors. Okay, the investors might get confused. What is he doing? What, like in each period you are going to change their way of doing things. So the investors is getting confused, right? So stick to the routine. It's like dance troupe practicing the same routine for a flawless performance. So even whenever I'm talking about this backpack, Dora the Explorer comes to my mind. Dora's backpack is something which has everything inside it. Everything inside it means it might even give her a house. That backpack is a magical backpack. So it's not like hers. Our backpacks are something which only includes essential things, right? Okay, so coming back to the topic, we'll be only carrying the essentials. So what's important to one person might not be important to another person, of course. So focus on what influences decisions. So what materiality means, what we have to stress upon. What's important to one person may not be important to another person. Okay, so it depends upon people. So materiality means only important things. Stress on important things. That's what it means, simply. Next one is full disclosure, the final one. The final convention is about full disclosure. Picture accounting as a transparent box. Nowadays, CMA exams on all, they will only allow transparent pouches inside, right? Because they want to see whatever is inside. If we are carrying bits and all, they want to see that. So that's why they only allows us to use transparent box and all in the exams. So it shows everything inside, good or bad, right? So this is what we meant by full disclosure. That is, honesty matters. Even if it's unfavorable news, we have to share it openly. We have to share it openly. So we have to disclose everything. Everything, in the sense, we have to disclose the bad side, also the good side. So that is what we call as full disclosure. So this is all about accounting conventions also. This is 2.1. So we have completed with chapter 2, 1.2, sorry, not 2.1, 1.2. We already completed with 1.2. That's it.